What's up, gang? Welcome to the Greatness Machine. I'm your host, Darius Today. I'm so pumped to have you here with me. Now, listen, the Greatness Machine, we're about two things. Number one, people who are living their passions. And number two, those who are creating greatness in the world and doing both of these things despite the odds against them. Each episode, we're going to feature interviews with game changers, business leaders, telling us their origin stories, what made them tick, what got them to where they are now. Why? So it can help you step into your greatness within your life, your business, and your career. Occasionally, you might hear a few solo episodes from myself, moi, as I leverage my 20 years of entrepreneurship as a CEO and founder to help you grow and level up in your journey to scale your life and your business. So come be a fly on the wall, enjoy the conversation, and I'm stoked to have you here with me. Guys, welcome to today's episode of The Greatness Machine. I'm your host, Darius and boy, do we have a special guest, repeat guest, Adam Coffey's in the house. What's up, Adam?
Hey, Darius, how are you, my man? It's good to see you. It's been like almost a year. I got to keep writing books so I can keep on checking in on my old friends. And good to see you. And, you're doing really well. So, life's good for us both. Good to see you. Good to see all and say hello to all your listeners out there, too.
Yeah, man, it's great to have you back. So Adam's team was doing their job. They reached around. I'm like, oh yeah, man, I want like Adam back on the show. That was an awesome show we had last time. And I know it's been a minute. We've had stuff happen in your life and in my life where we're crossing paths in our own ways. But what I'd love to do is kind of give the audience a little bit of your formal bio. And we had a great previous episode. I'll make sure I put a link to the previous episode in the show notes because we went really deep into Adam's background. I want to have him give some of his background again because he's done some pretty interesting stuff. But today we're going to be talking a lot about entrepreneurship, private equity, and if you want to get it right, how to get it right by positioning your company for the best exit possible. But just for those of you guys that are not familiar with Adam or didn't hear the last show, he's the founding partner of CEO Advisory Guru and 3-time number one bestselling author and top 1% speaker. What's funny is I see Adam on your social, he posts all the time. Like he'll post the category for private equity on Amazon, and he's got like 4 books in the number one, it's like top 10. He's like 4 of the top 10, and I'm like, man, you are ridiculous, dude. It's really cool to see it.
Hey, it's a blessing. My books never leave the top 10, and it's like that's a special place to be. But just so your listeners know, I donate all my royalties to charity. So
nice. Well,
yeah.
That's very cool, man. I appreciate that. And you don't get to the point of writing books like that or advising CEOs the way that he does unless you really go and do the work. And he's a CEO with over 2 decades of experience leading PE-backed companies, generating billions of dollars of enterprise value. So Adam's no joke, and really pumped to have you back here, man. What I'd love if you wouldn't mind, kind of give us just the for the listener that didn't listen to the last episode. And again, we're going to put in the show notes so you guys should check out the old episode. Give a kind of a quick and dirty on your bio because you have a really interesting bio, and I know it's a lot for me to ask you to give us on the quick and dirty, but if you wouldn't mind, give our listeners some of the origin
story. Let me do it quick, just for people who don't know. So. Hey, there's been many versions of me. And I think for all of us, our lives are a collection of experiences. So young Adam, starting out, soldier, U.S. Army. Military taught me something about discipline, teamwork, leadership. That led me to an engineering career. Engineering made me a real meticulous planner, always having a plan, everything scripted out. The life throws you a curveball. Planes fly into buildings, wars happen, pandemics happen, but we adjust. But there's always a plan in place. I'm a pilot. Pilots don't take off unless you know where you're going, and then you deconstruct the trip. I spent 10 years at GE during the Jack Welch era. This is before tech. And so, GE's number one on the Fortune 500 list. Jack is the world's most admired CEO. That company is growing so fast. The world's largest company is doubling in size in under 3 years, every 3 years, over the entire time I'm there. Great place to learn how to run a business. Then I spent 21 years as a CEO building 3 large companies for 9 different private equity firms. Multiple exits, all of them started as a turnaround. I was a turnaround guy at GE. Even the world's most admired company had business units that weren't performing. So I was turnaround guy, and then massive growth guy. And a buy and build guy. So I bought 58 companies, combined them in the companies or platforms that I was building. billions of dollars in successful exits. I spent 15 years teaching, in the executive MBA program, still do multiple universities. I'm a guest speaker, guest lecturer. And that led me to kind of the academic side, writing books, trying to be helpful to others. And so I now have 4 #1 best-selling books. And you can find them on Amazon or anywhere books are sold. I got bored, to be honest. After doing this for 21 years, I'm like, okay, I need a new challenge. This is not fun anymore. And I was enjoying teaching and giving back. And so I started a consulting business. And I hung up my CEO cleats. I'm done. Phone rings all the time. I got asked like 3 times this week, Adam, will you come back and run a 4th? No, done. Don't want to be a CEO anymore. But if you're looking for board members, potentially talk to me. So I now do 3 things. I work with private equity. I work with about 15 firms. I do operating partner kind of work. I sit on boards. I coach and mentor their CEOs. I also work with founders. I'm working with 71 founders all around the globe. I've got companies and entrepreneurs I'm working with on every continent. And these 71 companies are all scaling, learning how to do M&A, preparing for exits. Most all of them will exit to private equity, at some point in the future. So I'm doing that. And then I'm still teaching, seminars and books, doing my books. And so those are my 3 wheelhouses now. I'm having fun, but I was telling you off camera, it's like, man, I'm working more hours than I did when I was a CEO. I'm doing calls on weekends. I'm doing calls at night because in Australia, it's the next day. And it's like, man, I didn't know I could get busier, but I found a way to actually be busier. So I guess I'm doing okay. I'm making a ton of money, but I'm having fun. And that's what I was really looking for. So I just turned 60. I've got 10 years left in my working career. I'll never stop working or messing around, but it's like I've got 10 years left of what I'm calling my formal career. And so what do I want to do? I want to help your listeners learn how to succeed, learn how to beat the odds. That's what my next 10 years is about. I want to impact as many companies as I can without getting bogged down by just running one. So that's my wheelhouse.
Love it, man. So making the transition, and I think a lot of times, like I did this too, by the way. I exited my last business, and I made a list of like, what could I do next? Now I was 41, so I was like, I'm like not done, like not even close, right? Like I'm like, and for me it was like, I got to go build the next thing, right? And on top of the list for me was like coaching CEOs on growing their companies.
Yeah.
So I went out because I think everyone's like, like, especially there's this like, what's the old saying, like those that can't teach or whatever. And I'm like, I don't know, man, I could. I just wanted to give back, and I thought it'd be interesting to not be the entrepreneur, to actually just be coaching the entrepreneur. And what I quickly found was I was like, man, to your point, like I think there's a romantic part of doing that, and then the reality is you're like in it and doing it, and it becomes more of like a lot of work. What has been like outside of that? You're working a lot. You love what you're doing. Is there anything about that where you're like, oh, that was surprising. I didn't expect that to be what it is compared to a much more of a corporate environment, or rolling up companies, running 3,000 employees, being in these big companies. What's like the biggest difference for you?
I got to tell you. So I'm, if there was any surprises, along the way, I can summarize it. I recently, my taxes were recently filed, and I had 52 K1s. I'm an owner in 52 different companies, and the opportunities to invest. I wasn't really expecting that. It's like, so I've generated a lot of income in my life, over the years. So I wasn't really seeking to generate wealth. I was more or less just saying, hey, I've been a CEO. I'm bored. I want to do something new. I'm a wealthy guy. I'll cover my cash flow. I'm buying jet fuel, by being a coach and a consultant, and just paying for my lifestyle expenses, call it. But the opportunities, so many opportunities to invest in great companies or to be thoughtful, with entrepreneurs, and getting opportunities now to invest in a lot more private equity firms. Most of the private equity firms I work with, they give me access to be an investor in their co-invest funds. And so I don't pay carry. I don't pay management fees. I'm a direct investor, just like an employee is, of a PE firm. So I'm doing a lot of that. And it's so funny because I've made a ton of money, but I've probably deployed 2 or 3 times the capital I actually made. So negative cash flow, right? And 52 K1s. I'm like, good Lord. It's like when you're waiting on that many K1s to come in, to file your taxes, it's like, it's amazing. So somebody said, asked me a similar question recently. And I told them, if I could have done my life any differently, I think I would have stopped being a CEO probably 10 years before I did, because the opportunities, when you're a CEO, you're living your life with blinders on. It's like you're focused on your company, building your shareholders' value. But when you take the blinders off, all of a sudden it's like, all these different kinds of investment opportunities are out there. And that was a little overwhelming to me, to find me, at this stage in my life, I'm thinking I have a lot of my net worth is tied up in illiquid investments, things known as companies. And, over the next 6 years, they all cash out, sell, money's flowing back this way. I'm finding me, that money's still flowing out because I'm continuously investing in different things. And so the opportunities to participate has been one surprise. Second surprise is, man, I have gotten a chance to get involved in so many different industries now, and to find that my tools that I use to build companies work in every one of them.
Interesting.
And so my 3 companies I built were each in different industries. And so I kind of developed this generic skill set and way to go immerse in them and help them grow. And now I'm working with 71 entrepreneurs, and there's a lot of repetitiveness. I work with 9 companies, 9 roofing companies, 3 dentist roll-ups, so dentists, buying other dentists, doing dental roll-ups. It's like, industry after industry, I've got multiple companies in each industry and space. And I'm learning a ton about a really wide ranging collection of industries and companies. And it's funny sometimes to see a lot of the similarities. So I'll give you an example. 2024 was a pretty tough year for a lot of industries. The high interest rates, caused a lot of companies to slow down on investments. And, and it's like, I was in a board meeting yesterday, a company I'm on the board of with a PE firm. And I'm listening to the story and I'm thinking, 25, 30 of my companies could have been in this room in 15, 20 different industries, and it would have been the same story. 2024 was kind of a rough year. And a lot of people are looking at 2025 as kind of a rebound year now, because there was a lot of pressure. These high interest rates, caused inflation, and so the combination of that really stifled growth in a lot of different industries. So, it's been fun. It's been interesting.
That's cool, man. So, now that you've been out there, you're working with 71 different founders, and a lot of different companies, and you're working with a lot of private equity. What's the number one, when you look at the different groups and you look at the people that are really exceptional, that are doing really well, what's the number one trait that you see amongst the founders and CEOs that are ahead above the rest, as far as like really being successful, growing their business, doing the right things to create that enterprise value so that they can, really build the business of their dreams?
So, I talk sometimes about what I'm going to call the accidental arrogance of success. If you think about how hard it is to succeed in business, just in general. So 34 million small companies in the US, but only 7% get to $1 million in revenue. And only 4% of those get to 10 million, but only 40% of them are profitable. 65% of them will be gone, in under 10 years. They'll have failed, closed up, moved on. And so success is hard to find. And so entrepreneurs who achieve some level of success, it's hard not to. Sometimes they get, I call it accidental arrogance, because it's not even in the way that they portray themselves. But we get overconfident. We think we know everything there is to know about business. And so what separates some entrepreneurs apart are those who recognize, I still have a lot to learn. And even though I've been successful, what I call successful at 10 million in revenue, someone else is doing 100 million. And when they're at 100 million, someone else is doing 1 billion. And you look at a guy like Elon Musk, and everything he touches is billions, and they're entirely different industries every time. And so recognizing that we can learn from others, surrounding ourselves with people who potentially are smarter than us. And smarter doesn't necessarily mean that they make more money than us or they've generated more wealth than we have, but there's a lot of coaches out there who've never, built a, $1 billion business like I have, but that doesn't mean that they don't add value or they don't know their space, right? So, I would say people that recognize that there's more to learn and they never stop learning and they adopt an attitude of, if I surround myself with really smart people, and first of all, if I'm the smartest person in the room, I'm in the wrong damn room. And I need to get into rooms where I'm not the smartest person, where I'm learning from others who've kind of walked in the shoes or on the journey that I'm seeking to travel. And I build that network of people, whether it's coaches or mentors or peer groups, whatever that might be for them, then they're open to kind of learning and raising their bar and getting to the next level. And then the second thing I'd say is that those who learn how to hold themselves accountable are doing much better than those who don't. So what do I mean by that? If I'm a business owner and I'm having a tough year, I probably didn't even have a budget in the first damn place. But if I did, and I'm off budget because 2024 didn't play out the way I thought it would, if I'm independently owned and operated and I'm a founder and I don't have a private equity firm who is pushing me or forcing me or, driving me to don't accept mediocrity, don't accept it's a bad year, what are we going to do differently? How are we going to pivot? How are we going to steal share from our clients? What else can we do to make up for this gap? When I was the CEO, if I didn't perform, I got fired. If I didn't perform, it wasn't acceptable to just miss your numbers, and so entrepreneurs, a lot of us as entrepreneurs, there's no one to hold us accountable. And if we're okay with the fact that this is going to be a mediocre year, oh, well, I'll live with it. I'll do better next year. That entrepreneur is not doing as well as someone who wakes up every morning and says, I am not going to accept being down. I'm not going to expect being flat. I will find a way to hit my growth targets. And so I think those are two, having and surrounding ourselves with people who can teach us, more than what we know today. That itself, is going to raise our probability of reaching new heights. And then figuring out how to hold ourselves accountable. I'm on the board of a founder-led company. It's we're building a legitimate board. Why did the entrepreneur build a board? Especially when you see what my board fees are, because they wanted to hold themselves accountable. Great company, big growth spurt, but knows that there's a lot more for him to learn on his journey. And so, Adam, you know what? Forget the coach thing. I want you on my board. I want you involved as an extension of my leadership team, and I want, let's put governance in place. Let's force ourselves to act like a PE, run company and help force that accountability on my organization because, we want to maximize our potential. Those are kind of the two key areas. Surround myself with good people, figure out a way to hold myself accountable and not accept mediocrity as an okay result.
Do you think that, I think that, number one, I couldn't agree more with what you just said. What I would like to ask though is, and I think that when people hit a certain size, and this might be the ideal person that you're working with, is already at some sort of size where bringing in an Adam to work with them, either at the board level or as a coach, someone that's been there and done that, they can obviously afford you, number one. But number two, they have the right mindset. They have a growth mindset, as you were talking about. So they're willing to pay up to surround themselves with great people, and they have the right mindset to want to do something that they haven't done before. I'm curious what your thoughts are on this, because I had those same realizations. But I think for every, you kind of went through the numbers on how many people don't really have businesses that probably could do that, either A, have the means to do it because they're financially not successful enough, or B, they're just not scaled enough where it even makes sense. But there is, deep down at these probably lower mid-market, the lower mid-market, is you have these entrepreneurs who are younger. So this is for my younger listeners, someone that has the ambition, but maybe they don't have the size, the experience, or the money to bring on an Adam to help them. What's your best piece of advice for them to get to that next step?
Well, if they're listening to us talk about this, they're already doing it, so let me just start there, right? When people reach out to me and they say, "Hey, Adam, how can I engage with you?" I have this like offering sheet that I send to them. It's like, here's how I work with people. And it starts off with a link, to listennotes.com with me in the search criteria. I've been on over 200 podcasts. You can listen to you and I talk and, hundreds of podcasts that I've been on, and there's plenty of nuggets there, and it's free. It's free. It doesn't cost you a dime. And then I've got my books, and my books, Kindle version, are $4.99 each US, in the US. And so for $20 in about 20 hours, I call it the $20 MBA. You can get 20 plus years of CEO cliff notes from a guy who's bought 58 companies and had billions of dollars in exits. And it's like, here's my cliff notes on how you do this. So for $20, you can read my books. I'm teaching a seminar here in Dallas on February 1st and 2nd. It's a weekend, and I don't even know where the promoter winds up pricing it. It may be $200, it may be $1,000, whatever it is. It ain't a hell of a lot. You come here and spend 2 days with me, and that's a different price point. And then coaching is different price points. And then boards are different price points. And so I would say you'd be surprised. While I do have some clients, I have clients who are billionaires. I also have clients who have $1 million in revenue, or a client who hasn't bought a company yet and is looking to buy the first company. And, by listening to my podcast, by reading my books, they can engage with me. And so I think the key is for someone like me, or even you, we try to add value, at all these different price points in our ecosystem, because not everybody can afford to engage, at a level, at the highest level. So I want to make sure that I'm touching as many entrepreneurial lives as I can. And so I do that by trying to impart wisdom and value in different methodologies. I do all my podcasts, I do all these podcasts. And, if I ask my clients, where did you learn about me? I read your book. I heard you on a podcast. I read your books, heard you on a podcast. Podcasts live forever. If I had a podcast, I would develop one audience. But when I'm on 200 different podcasts, I'm touching 200 different audiences. And so, for me, there's value here, but I'm trying to impart value. It's not an infomercial. I'm trying to help. I want to help the people that listen to your podcast. So I'd say recognize that it might be cheaper than you think to surround yourself with very talented people. I can listen to Darius and all the guests that have been on this podcast, and I can learn a thing or two.
Oh yeah.
And it doesn't cost me a dime. It costs me time.
Yeah, no, it's a great point. And I've talked a lot to like younger entrepreneurs about this, and I'm like, you said you're turning 60. I'm turning 47 next year. And I'm like, dude, we grew up at a time analog. There was no, like, I was in high school and the internet came out. Okay. And
Yeah.
I was in college when I got my first cell phone. Right. And I was almost 30 years old when the iPhone came out. So we grew up in a time where access to information, you had to go, physically walk into a library to go buy a book. You had to go and walk into a bookstore to buy a book. And like the only access there was whatever some person had written a book about. I couldn't go to Amazon and search. I had to go figure it out for myself. Right. And so what I've told a lot of young entrepreneurs is I'm like, look, you have access to so much information. It's overwhelming. Right. But you also have access to be able to curate the information. So you get cheap access, and so does everybody else. The downside is you get to compete against more people that has the same access you do. The upside is you get access to a lot of information. So to your point, someone can read your 4 books and listen to your 200 podcasts and spend $20 to download 40 plus years of experience. Like, yeah, where do I freaking sign up for that? Right. Yeah. If I'm in my 20s and want to learn.
That's my point. It's like, you don't have to have, Fort Knox, in an armored car to work with me, because you're working with me right now. You're listening to me. Right. So, it's like, and that is the glorious thing. I was laughing when you were saying that inside, to myself, because when I started in my career, I'm working at GE, #1 on the Fortune 500 list. There's no cell phones. There's no voicemail. There's no email. There's no computer on my desk. There's 5 channels on the TV. There's no internet. It's like, imagine that world. It wasn't that long ago. That's me in my 20s and in my 30s, early 30s is when this stuff started hitting the world. And I remember, my first computer as an engineer was made by a company called Osborne. And they called it a portable. And it weighed like 30 pounds, and it had a flip down keyboard with a little like 5-inch green screen. And this was like before the Mac, came out, and I'm like, I thought I was in heaven. That was like a $10,000, $20,000 piece of hardware sitting right there. And it's like, man, the world is moving so fast. The world has become so small because of social media, because of platforms like this. I don't need a book in the house if I didn't want to. Anything I want to do, I could go on YouTube and I can find a video of somebody doing it, and I can watch and I can learn. And so you're right. There's so much information. We just have to plug into it, and information and technology is moving so fast today. We're in the early days of AI, and
right.
AI will transform business. Right now, we're in the Stone Ages learning how to make fire for the first time with AI, but it's coming, and technology is going to just completely disrupt the world of today. And 20 years from now or 30 years from now, our kids are going to be living in an entirely different planet. And so it's coming fast. Those who embrace change and learn how to adapt to some of these newer technologies will go so much farther, faster.
I have a question for you on that. And it's funny. I was having a conversation with a good friend of mine. He's a venture capitalist in San Francisco over the weekend. We were like thinking about what the world's going to look like through AI. By the way, the solution we came up with is it's Ready Player One for 80%, for like 70, 80% of the world. And then there's going to be 30% are going to say like, no internet. I'm living off the fat of the land. And there's going to be 2 cultures. That's my dystopic like mindset. But one of the things that we talked about was, okay, we live in a world still, even though it's changing, where there's a combination of analog and digital. I got to walk into buildings to buy stuff, but a lot of stuff gets delivered to me automatically, right? I have these old blue collar businesses that are owned by a bunch of, boomers whose kids, want to become influencers and don't want to take them over. And, you mentioned a couple of them, roofing company. Right? There's roofing companies, there's plumbers. These are businesses, by the way, that are a lot of them are very substantial. And the next gen doesn't want to take it over because they don't want to be a plumber. And so we live in this world of like, it's kind of like cognitive dissonance from a private equity standpoint, where you're like, man, what do you do with that business? What do you do with those businesses? Now, if you built a substantial business in that world, now the other side of it, we got the stone age of AI happening. And I look at it and I go, that's fascinating. Which of these businesses is going to survive and win? I'm sure some format of them will exist 20 years from now, 10 years from now. But when you think about it as a former CEO, building billions of dollars of enterprise value and seeing with a smart set of eyes and brain what's happening, how do you think about that from the perspective of being an entrepreneur that's maybe running these businesses that may become the next Blockbuster, given the speed of change of technology, to take advantage of the business they built and not get left owning a Blockbuster? How do you think about that?
Yeah. So I think when technology aids us, we accept it without question, and we adapt, to it very quickly. And so a fear of technology and change. So I'll give you an example, ChatGPT, right? So I'm an author, I write books. Well, so like everyone else, when ChatGPT first came out, I would take a LinkedIn post, I'd throw it up in there and I'd say, help me write a better LinkedIn post. And, it was entertaining for a bit, but after a while, I'm like, I can look at a post on LinkedIn and in 2 seconds, that's ChatGPT. It's like, and so it's like, I got bored with it. And I quickly went back to, I want to talk in my own voice. I want to convey a message in my own way. And that's the human element that's not yet capable of being replaced. But I'm open enough to play with it. And, first of all, authors out there, never upload a book into ChatGPT and give it to it and say rewrite it. But I did paragraphs, chapter, here or there. I play around with it, and I'm like, you know what? I like my own voice better.
Yep.
And so, it's like but I play with it. I'm open to the technology, and I think that's the key. We don't necessarily have to be an early adopter for everything, but we should at least be willing to experience new technologies, because I do think it's going to come a long way. I was talking to a private equity firm recently, and so you're in the world of private equity. You've raised a substantial fund, and I think about the world of private equity and AI, and we were talking about how is AI going to change the world of private equity. Think about deal sourcing for a minute. Typical private equity firm probably looks at 300 SIMs or investment guides, and analysts have to read every one. And analysts who are junior members are deciding what should get passed on to mid-level or partners, VPs and managing directors, eventually, to up to the MD or partner level. It's like, we're relying on analysts to physically read 300 books, do some basic research, and tell us what we should look at. I think I can see a day coming where AI will, and of those 300, we dig in on 30 and we buy one. And how much time is wasted reading those SIMs? Can we use AI to screen companies for us, eliminate the hundreds of hours that go into trying to look at the top of the funnel to figure out which 30 we want to dig into to get to the one? Could I have AI do the 30 to, do the 300 to 30? And I look at, but I think for a lot of industries, some of this newer technology that we've seen, it won't replace the human. It will augment the work the human is doing. And so I'm going to go to something that I call high value work, low value work. If I'm a plumber, you use plumbing as an example, then high value work is me in your house cleaning the drain, snaking out the drain line, installing the new toilet, fixing your clog, putting the new valve in the wall, because I'm a high paid resource. And when I'm doing that work, I'm doing high value work. Low value work is me driving my truck to your house, filling out a work order, ordering parts, going to pick up parts, doing all of this mundane crap. If we can use technology to automate, outsource, or eliminate low value work so that humans can spend more time in any job, even a janitor has low value work, high value work. If we can focus on separating our tasks, and I'm using, a technology to help speed up the low value or replace the low value or take it off my plate so that I can spend more time doing high value work, I'll become much more productive. And so I think these technologies we're seeing today, we're in the Stone Ages. It's spring training. We haven't even got to game one yet of the new season with AI. And there are a lot of companies that are spending hundreds of millions of dollars right now to kind of figure it out. And so I'm patient. I don't need to, first of all, as an investor, I'm not out investing in a bunch of AI companies. It's going to be a very disruptive technology, but I've got big players out there spending literally billions of dollars. And any small company is going to quickly be disrupted or overtaken, by a big company. There's an early adopter advantage. And if I can get ahead of technology in some way, I might have a VC opportunity to sell a piece of technology for a large amount of money because a big provider says that gives me 3 months head start, on my competitor, and so I'll pay $500 million for that little piece of code that I think is valuable. But I'm patient here. I'm gonna sit back. I'm gonna let the world kind of get it figured out. I'm playing with it. I'm aware it's out there. High value work, low value work. And I think if we use some kind of framework, always be open, always think about what does the human do that's high value work that we want to do more of, and how do I outsource or automate or eliminate the lower value stuff? And I think we'll figure it out, right? So we never had cell phones until we had cell phones.
Right.
And you cannot, literally walk through a day and just look, and anywhere you are, people got their face in front of this thing, And, if I was in the 1950s and I came forward to today, the first thing I noticed is that everybody's holding one and everybody's looking at it, doing something with it. I don't know what it is, but it's like the entire world's changed. You can't even protest with two hands anymore because one hand holds the camera while you're burning down the house, with the other. It's like you got to learn how to do everything one-handed so you can videotape it and get yourself in the action. It's like no one's living in the moment, and so the world's just changed and it's changing. And so I say, Darius, be open to the technology, be willing to play with it, but also be patient. Let it get developed until it gets to a point to where it can help you. But don't be afraid of it. Don't think that your job's going away. My brother and I owned an insurance agency for 15 years. And I remember when autonomous driving came out, I owned a Tesla at the time. And the first day they turned on autonomous driving, at the time I'm in Orange County, I'm driving down the freeway. And I'm like filming myself. If I had an hour, I could go through the 40,000 pictures on my phone and probably find it. That's the other thing. We film everything. And then we never look at it ever again.
Right.
So I stopped filming it, live in the moment, and I'll look at someone else's video of it. But I'm driving down the road and all of a sudden the car's driving me. And I'm thinking to myself, my insurance agency is going to go bankrupt because autonomous cars mean cars no longer have accidents. No one's going to longer need car insurance. And brother, I called my brother, literally, we better hurry up, sell our insurance agency because there's going to be a day where there's no insurance agencies needed. You're going to pay pennies on a dollar because cars are going to drive themselves and you take human stupidity out and there will never be car accidents again. Well, of course, that's going to take 50 years, but it's coming, and Elon keeps putting it out. And now other cars, I've got my Escalade, I jump in the Escalade and that thing drives itself. And, it's like technology's moving fast and I'm open to it. I like it, but I don't have to try to force fit it. I know it's there. I pay attention to it. When it's ready, I'm going to embrace it. But I don't think it ever replaces the human.
All right.
It augments what we do.
I hope you're right for all of us, because I think that if it does, then we got bigger fish to fry.
Well, have you seen Elon's, all these robots walking around? I'm like, I can't wait to hire me a bunch of robots. Man. I want one of those.
I'm like, I'm going to have one that washes the car, takes the dog on a walk, does the laundry, cleans the house. I was like, can I get one of those?
Yeah, doctor says I need to walk every day. I'm going to send my robot to walk. I'm going to take a nap. It's like, it's like, I want one of those guys for sure.
Well, we were talking about that specific when we were talking about this AI thing. I said, the cool thing about that is for healthcare, because I think that you're going to have like people that's like, hey, my robot picked me up and put me in the tub. Like I think it's going to actually be really helpful for an aging population. I wanted to take a pivot here and talk a little bit about, before the show started, I was telling you about some of my experiences now being on the investor side, trying to buy companies. And I had a friend, and you'll appreciate this. His name's Rich Manders. He sold his company as a robotics company. Speaking of robots, sold his company to a private equity firm out of the Northeast. Ended up like going for, sold a control stake, did a second bite of the apple. They did a bunch of roll-ups. He did really, really well. And I saw him at Harvard. I went to an executive education on M&A at Harvard about 8 years ago. And we didn't know each other then, but he was a speaker there. And he comes up with this thing called Sparkle. And Sparkle is essentially like his acronym for like how to not get screwed by private equity when you sell your company. And he said, you got to do the Sparkle process. And one of the things that he said that stuck with me, and now going on the other side of it, I find to be interesting. He said, part of the private equity playbook is to drag you into a process, show you a big number, drag you into the process, and then just slice that number down to size and get you to a much lower number when you're in the process and tired and willing to take a smaller check. And I remember thinking, he said, now, if you do my process, the Sparkle process, and he has this like 10-step process of how to get ready to sell your company to private equity, none of that will happen. And I was like, oh, that's interesting. That's part of the private equity playbook. They teach them that at University of Chicago. I didn't know that, right? So I go back to I have 100 pages of notes. I go back to my partners. I'm like, hey, guys, if we were going to sell our company to private equity, they're going to take us in the process. They're going to give us some bullshit number up front. Then they're going to cut us down to size. So we got to get ready for that stuff so that doesn't happen to us. I'd love to hear how you respond to that, because as an investor now, I'm like, that's not no, look, I'm not saying people don't do that. I'm saying we don't do that as an investor. That's not how we approach it. I'd love to hear your thoughts on how an entrepreneur should think about something like that as they're getting ready to maybe sell their company 3 to 5 years down in the future.
Yeah. Well, first of all, I don't want to get into morality, but I'll say it's unethical. That's not how I treat buyers. I bought 58 companies. I never once threw out a high number and said, I'm going to work them down in diligence. That's not what I do. So I don't like that kind of behavior. If they're teaching that, boy, put me in that program and let me lecture to these professors who've never sold a damn thing, and I'll set them straight on that one. Because that's one of the ways private equity gets a bad rap,
Right.
a bad name. You know what? If I get, when I am talking to a prospective deal, I take their information at face value. And I price it based on face value. What they've told me I take as accurate. If I've had questions or I see some anomalies, I might try to flush it out a little bit. But I'm gonna look at what companies in an industry are selling for. I'll use my tools, and I'll give them what I think is my fair assessment of what that company is worth. And then I explain to them that diligence is merely me affirming what you've already told me.
Yep.
And as long as everything checks out, that's the price that I'm going to close at. And I even have a framework. If I'm doing a quality of earnings, and so here's what I'll tell you. PE does way too much diligence, it feels like, if you're an entrepreneur. But entrepreneurs who buy other companies don't do enough. It's like they don't do any.
Right.
Most of them don't even do a basic Q of E, and to verify that the numbers, a quality of earnings, to verify the numbers are accurate. So I take what they say face value. I'm going to dig in and do a Q of E. When I do quality of earnings, I have a framework. If it's within 10% of what I thought it was, I move forward at the price that I put on the LOI. If it's 10 to 30% off, low, I'm going to reprice. But I'm not leading with a high number that I'm going to then reprice and game them. I took their number based on the industry trading, range, and how I like the company. I give them fair market value. I verify what they say. 10 to 30% I reprice. Below 30%, I simply walk away. I'll explain to them, I don't want to offend you, but we found some problems. Let me explain what we found. Want to make sure we point it out. That PPP loan you got is not revenue. that ERC tax credit you got, that's not earnings. And so it's like, I'll point the anomaly. And so what I find is most sellers aren't trying to game me. They don't know what they don't know. They may be unsophisticated, don't have sophisticated level of accounting and checks and balances in place. And so they think they're doing it right, but they're not, and their accounting firm that's, closing their QuickBooks file every month, they're not any better, and so, I'll do that. Meanwhile, if someone says, hey, my company's bigger than what it was when I gave you that information, I want more money. Same thing applies on the upside. 0 to 10% up. Look, I buy good companies run by good people. I expect them to be growing. I've priced that in. But if it truly is, I'm taking 4 to 6 months to get a deal closed and they've grown by 20%, and it's like, hey, I buy good companies. I pay fair market value. I'll be willing to consider paying more, and so, but they got to ask on that side, right? So I'm not going to ever lead with that, but I buy good companies. I try to pay fair market value. I hate a firm that literally is going to walk in there and say, I'll pay $100 million for that. And then I get you into diligence, and 60 days later, when you're wore out, I say, you know what, based on this, and this, I can only pay 85. And that, I don't want to live in that world. And I do not work with PE firms that play in that world. Just being honest. So why does it matter? Let me tell you why. I don't need to get a good deal to make money. If I pay fair market value for good companies, multiple expansion and arbitrage is going to create my return, and it's naturally occurring. My last empire, I bought 23 companies and put them together. On average, I paid 5 times for each company because that's what they're worth. Some entrepreneurs wanted 8 times. God bless you. You'll probably find some idiot out there willing to do that, but it won't be me, because based on my research, deals done in the industry, fair market value is 5x, and I'll pay 5x. And I bought 23 companies, average price 5x. And when I put them together, I sold it for 14 times. And that's 9 turns. So for every dollar I bought and paid $5, every dollar of earnings I bought and paid $5 for, I then turned around and sold for 14. And that $9 of profit, is what generates my shareholders' return. And if I'm going to be partnering with this person, I don't want to start my relationship because I gamed them. I'm going to start my relationship on a fair note because I paid fair market value for a company. Come on my journey. Let me show you my model. Let me show you what your rollover investment's going to do in my company. Brother, we're going to make money together.
Right.
And you're going to get a piece of this action. And I'm going to make enough to where don't need to game you in order to do that. So that's how I personally have played. Call me old school. But that's you touched on a nerve there. You got me going here. It's like,
no.
Arbitrage. And so why is it naturally occurring? Why can I buy a company for 5 times? I told you already, 34 million small companies in the US. There's not enough buyers. I'm doing 3 roll-ups right now in bookkeeping and accounting. 3. Probably about ready to start a 4th. And there's 1.8 million of them in the United States. There aren't enough PE firms on the planet to buy them all, and so they're plentiful. When they're plentiful, they trade for low multiples. But where there's 34 million small companies in the US, there's only 3,000 companies on the entire planet that have $1 billion in revenue. So as companies get bigger, they trade for higher multiples because they're rare. And since all PE firms invest 6 to 8% of their fund in any one company, and they never invest more than 12, then a bigger fund has less opportunities to buy companies because there's not as many of them if they're a big fund. And when one climbs the pyramid and gets bigger by buying a bunch of small and integrating, putting it together, and comes up there, they have to pay a lot more for it because there's not as many opportunities or at bats. And so me making wealth is naturally occurring if I just treat people fair, only buy good companies, pay fair market value. I'm going to get my returns. My career batting average, worst exit ever, was 2x.
Wow.
So 2x multiple of invested capital. For every dollar that was invested, I returned 2. It was during the Great Recession, by the way. Best payday ever, 11x.
Wow.
My career batting average, somewhere between 4 and 5.
That's amazing, so, man. That's top quintile. That's amazing.
If I can make that kind of return by buying a bunch of good companies and putting them together, then I don't need to game somebody. It's like it's naturally occurring. And that's a good point for your listeners out there. If you're looking to buy a company, don't buy distressed assets that are broken. It takes too long. There are people out there who do buy distressed assets, and I'm a turnaround guy, and I'm telling you, if you're a small company looking to buy an acquisition, don't buy a fixer-upper. Buy a good company run by a good person, pay fair market value, get bigger, sell for a higher multiple, create the arbitrage. In 58 acquisitions, I had one bad one. It was less than 5% of my revenue, and it cost me 80% of my headaches for the next 3 years.
Yep.
Life is too short. When you're doing a buy and build and you're working with private equity and you've got about a 5-year hold period, you can't afford to get it wrong. Think of it this way. Ty Cobb, baseball player, highest batting average in the history of baseball. He did bat over 400 some years, but his actual career batting average was in the mid 300s, which means he made 6.5 outs for every 10 at bats. In the world of private equity, in the world of M&A, you better be batting 900 plus, 950, 980. You cannot afford to strike out. One bad deal derails what you're trying to build, and it can derail it for years. So that's why my focus is buy good companies, pay the right price, don't game anybody, be ethical, because the person you're buying, if they're staying, becomes your partner. And then let this naturally occurring thing generate the shareholder returns you need for all. Okay, I'll shut up now.
No. It's but by the way, if you're interested, I have a friend who has he specializes in venture-backed private equity, venture-backed SaaS startups, and he's an accounting firm that does fractional CFOs, bookkeeping, and tax for them. They have 400 or 500 clients, and we had a retreat over the weekend, and I was like, "Have you ever?" He just bought his first firm, and I'm like, "Have you ever thought about doing roll-ups?" And he like it never done. I'm like, "Dude, he has a couple hundred employees." I'm like, "You have a platform, man. Like you should be scaling this." He's a former guest on the show. Was that something you could help with if I wanted to make the introduction?
Sure.
Yeah, what you were just saying right now, I'm like, he needs an Adam in his life, because and he's a smart guy, HBS guy, like really hard worker, built a beautiful company, great culture. So I'm gonna make that introduction. But
and something else I'll tell you too, just while you're on that note, we don't have to create a new exciting thing that doesn't exist to make money. We were talking about bookkeeping, accounting, payroll, 1.8 million of them in the US, HVAC, plumbing, boring companies in boring industries. You can make a ton of money.
Yeah, it's funny. Like, do you follow Scott Galloway, Prof G?
Yeah.
So Scott, he's talking about this. He's like, look, like if you want to create wealth, don't go into an industry that has 99% unemployment, like acting, right?
Yeah.
He's like, I want you to go into an industry that's like that they can't find enough people to be in it, right? And the 5 you just named, it's like bookkeeping. They're all boring. People's eyes glaze over when you say them. And there is a ton of people getting rich in those industries because they're good at what they do, and they know how to build companies. So I'm with you, man. I like the boring stuff. I'm a singles and doubles guy. Like I don't give a shit about the home runs. So we're running a little short on time. We probably have time for one more question. Then I want to get to the greatness question for you. But when you start thinking about like entrepreneurs, like again, I think like you just kind of, when you described yourself as an investor, and even myself, when I think of myself as an investor, I'm like, I think we're the exception, not the norm. I think most private equity is. I have a friend that calls them economic animals. And he's like, look, they're trying to squeeze every little penny to look good in front of their IC. And I know there's good guys out there, but and maybe some better than others. But I think in general, there's nothing wrong with being a little guarded, trying to raise money from private equity or to create an exit through private equity, which I know you specialize in. So when you're working with entrepreneurs, like what advice do you give them, or when you're thinking of the people you want to work with? What is the type of things that you're doing with them to make sure that they're positioning themselves to either A, build a great business that they can exit at some point, or B, get ready for that exit now?
Yeah. When I work with private equity, doing operating partner kind of work, I've got money guys who are interested potentially in an industry. They've got a thesis, thesis-based investing, and they've come across a book. Adam, take a look at this business with us. Help us identify. I'm looking for areas of risk. And I'm trying to help them assess, do we want to buy it? Do we want to pass? And where is the risk? And how do we price that risk in, and decide, to stay or go, and what price to pay and all that kind of stuff. When I work with founders, I do the exact opposite. I help them eliminate risk. So when I'm a buyer looking under the hood of your company, what are the things that I want to see that demonstrate to me that there's less risk? And if I do, I'm going to pay up to buy this company. I'm not, if the industry's trading at, let's say this given size at 6 to 8 multiple, I find this company, I'm not finding risk. My model's looking great. I'm like, man, I'm loving this person. I'm loving the business they built. I'm not just looking 6 to 8. I'm like, do I maybe need to pay 9, and just take this thing off the table? And it's a rounding error in my exit in 4 years when I'm 4 times the size. It's like, I want good companies. And so with PE, I work to identify risk. With entrepreneurs, I work to eliminate risk. So risk, may include customer concentration. It may include they've got too much project-based revenue, not enough recurrent revenue, or they've never done M&A before. It's a fragmented industry. Why don't we do our first small M&A deal to prove to the PE guys a year or 2 from now that, hey, we can be a platform and we can buy good companies and we can integrate them. We have experience doing that. And so I'm all about trying to check the box. Hey, you know what? We don't have a value creation plan. Let's create a value creation plan. Let's script out what the next 3 to 4 years, 3 to 5 years is going to look like, and what are the elements of growth, and how are we going to attract, and what's the measuring system, and who owns them, and it's like, let's put together a comprehensive strategic plan. Let's make sure that we don't have too much risk because we've got too much customer concentration. Let's make sure that we've got a good balance of revenue from our different verticals. Maybe let's consider making a strategic pivot because the total addressable market in this industry is too damn small. We need to make a pivot or two, and try to widen the addressable market. So it's like everything I look at when I'm evaluating it for a buyer, I apply the same lens when I'm working with the entrepreneur, and I'm identifying gaps and risks, and then I'm working with them to eliminate the risks, bend the growth curve. Most entrepreneurs sell a business, they're selling a story. Here's what my company's been doing. And when magically you give me too much money and buy it from me, it's going to grow like it's never grown before. And I'm like, dude, let's actually bend the growth curve and get on that trajectory. And instead of selling them Kool-Aid, let's sell them this new trajectory. And, and so it's like, I'm doing that kind of thing. So I think with most entrepreneurs, a problem is they wake up and say, today I'm going to sell my company. Let's start on that path. Well, I can't change the history. And so I'm putting lipstick on a pig and doing my best to pretty it up, but if you started a year in advance, 18 months in advance, 2 years in advance, we can completely change the trajectory of a company. We can focus on getting it to grow at a faster pace. We can demonstrate that we're a platform that as we get bigger, we're creating operating leverage, which means our expenses are going down as a percent of revenue. Revenue's growing at one pace, expenses are growing at another. The wedge in the middle is operating leverage. We've demonstrated that we can be a platform. We've done an add-on acquisition. We've got a 5-year value creation plan in place. I've got a solid leadership team in place. I've got measuring systems in place. It's like, now I got something special that I can take to market. So for me, that's the focus. Identify risk, eliminate risk, maximize exit value.
Love it, man. You guys, like anyone that hasn't realized it already. And I've spent 2 years going from being an operator to being a consultant for growth as an operator, not understanding the private equity side, to now investing for like the last 2 years. And I can tell you right now that the last 56.5 minutes has been a freaking masterclass for entrepreneurs to like literally down. Like, you should play this again 3 times over and take notes on what Adam's saying, because he just gave you guys literally probably tens of millions, if not hundreds of millions of dollars of free advice. FYI. So that's just me knowing, and who am I? Just a guy that cuts checks. But so I'm telling you,
big checks.
like the advice you just gave for our platforms that have done that work, like I probably won't even bid on them because they're going to be too expensive. That's the reality in the industry I'm in. So, but it's and that just goes to show you, I'm in an industry where there's a lot of buyers, but I'm telling you, you want to be the seller where there's so many buyers that are like, man, this guy, girl, they've checked all the boxes. They've de-risked the deal. They've done the things that Adam's talking about. So you guys need to, go check out all of Adam's stuff, because this is just, I love this stuff. You're blowing my mind. If you're blowing my mind, I don't even know what you're doing to my audience. So Adam, I know we're towards the end of the show. Where can people find you, get more information, get the books, the podcast? Where can they get the whole enchilada? And then I'd love to go to the greatness question.
I am on LinkedIn. I do not have a team of people in social media answering questions and inquiries for me. You go on LinkedIn, you connect with me, you get me. You send me a message, you're going to hear from me. And that's how I engage with people. My books are on Amazon or anywhere books are sold, Kindle, Audible. You pick a place, you're going to find my books. I'm not on Instagram, so let me just mention that. There is a fake Adam on Instagram that has 8,000 followers that's trying to monetize people. I've got my lawyers working on trying to get that shut down for Meta, with Meta, who seems to not care. But at the end of the day, I'm not on Instagram. you'll find me on LinkedIn. Why am I on LinkedIn? Because there's 830 million business people. 200 million of them are probably fake, but that's okay. My audience is on LinkedIn, and so that's where you'll find me. So find me there. That's where I am. Books are everywhere, and I love hearing from people out there who listen to these podcasts. They reach out to me every day, hundreds. I get up at 4:00 in the morning. I probably spend the first good hour of my day just flipping through all the messages I get and just trying to respond. If you reach out and you're trying to sell me something, you're probably not getting a response. But people who have questions or they're engaging, then I'll they hear from me.
Awesome. You guys, we'll put all that in the show notes. And you guys, like I said, do yourself a favor, get the master class known as Adam Coffey in your brain, read his books, listen to his podcast again, share it with your friends. But Adam, you ready for the greatness question, my friend?
Let's do it.
All right. What is the number one barrier to creating greatness that you overcome in your life, and how did you overcome it?
Believing that you can. Let's keep it simple. It's not about education. I went in the service right out of high school, and I cobbled together an education along the way because life just took me on a different path. So I didn't go a traditional route. And so I was always competing, like in the Fortune 500 world, I'm competing with the Harvard MBAs of the world, it's like, and so how did I beat them? How did I get to the top of the pyramid? I've held every job you can hold on an org chart. I got up earlier. I outworked them, I out-hustled them, and I refused anything other than success. And so I tell people it's like the biggest barrier to greatness is believing that you can. I hang out with billionaires, and I've been, I've got some friends that go to their house, you spend time with them. And I'm looking at him, I'm thinking, this dude ain't no smarter than me. This guy dresses just like I do. Matter of fact, I'm looking around his house. I'm like, dude, man, you need to do some remodel around this joint. It's like people, a millionaire knows how to make money, but a billionaire somewhere in their life went all in and doubled down and refused, to give up. And so I would tell you, Darius, that the biggest hurdle that people have is believing in themselves and believing that they actually can do this. I remember the first time I sold a company, and I had an 8-figure payday, that came in on that one, and I'm like looking at it in my bank account, and I'm thinking, not bad for an Army private who left home at 17, with $150 in his pocket. And there's been a lot of paydays, since then. And, it's believing that you can do it. It's not somebody you read about. If you get your ass up and say, I am going to do it, and I'm not going to stop learning, I'm not going to stop working until I achieve it, and you believe in yourself, you can do it. So the biggest roadblock to success, it's a mental block. Why can't it be you? Why can't you be the next entrepreneur to get a 9-figure exit? Why can't you build a business, that's worth hundreds of millions of dollars or $1 billion? It's like, you can do this if you believe and you apply. You get knocked down, you get back up. You get back in the fight. I was never the biggest guy, but if you knock me down, you better keep knocking me down, because my ass is going to keep getting up, and I don't know when to quit. And I will outwork you. I'll get up earlier. I'll go to bed later. I'll spend more time, and I'll win, because I believe that I can. So believe in yourself. Believe that you can do this, that you can succeed. Not other people. You. Look in the mirror. Success starts with the person you're looking at. If you can get over that, you'll find success.
Love it, man. Adam Coffey, you're a gentleman and a scholar. Dropping knowledge for our audience. Appreciate you, my brother. Thank you so much for coming on the show today, man. So much gratitude.
Good to see you. I got to get you on a podcast, talk about your success. Ladies and gentlemen, this guy has got it going on as well. You need to subscribe. Follow this guy. You're going to learn a thing or two as well. Good to see you.
Thanks, my man. You guys, until next time, peace out. We love you.
She's my lover.
are listening to The Greatness Machine, and that's a wrap for today. Listen, if you love what you heard, subscribe to the show on whatever podcast platform that you're tuning in on so that you don't miss any of our future episodes. We have tons of great people coming on, and we're stoked to have you here to enjoy it with us. Leave us a review. Tell us what you love most about this particular episode. We love getting the reviews. We love to see what you guys love most. And if this particular episode, made you think of someone who's leveling up in their business and in their life, print screen, share it with them. Leaders are the best givers. And after all, we're all here to support and grow with each other. And in case you want to see some of the fun behind the scenes shots or some of the things that we're doing, I'm actually writing about this in my weekly newsletter. Go to www.therealdarius.com and subscribe to my newsletter. We're talking about fun things like business and life and mindfulness and cryptocurrencies and gosh, I don't even know, everything and anything, but it's tons of fun stuff I write about. I try to get it out on a weekly basis. You can subscribe at www.therealdarius.com. And with that said, look, thank you guys so much. I appreciate you. I love you. Peace. We're out of here. See you guys on the next one.
She's my lover.